So let's look at some of the slides regarding Musharaka, and much of this discussion is based on my reading from Sheikh Mufti Usmani book on Islamic Finance, IOFI standards and other things. So when we look at the Musharaka, commonly translated as joint venture, partnership or equity partnership, this word is derived from word shirka, which means sharing, to share something. So partnership is about sharing something, coming together, bringing money and resources together in order to do something useful together. So the partners in this venture, they would share profit and loss from the business activities that they are undertaking. It is called equity partnership, and the mode of financing is equity-based mode of financing. So what is the idea of Musharaka? Idea of Musharaka, as you can see from this picture, you have investor A and investor B. They join their resources. In this case, investor A is investing $20,000, which is 20% of the business, and investor B is investing $80,000, which is 80% of the business. So business venture is 100K. We have 20-80 capital contribution split, and now this business, maybe they are developing a mobile application app, maybe they are investing in the real estate, or maybe they, regardless of any of the legitimate business that they are doing, at the end of the day, this particular business will either return some profit or there will be some sorts of a loss. Islam here puts certain rules when it comes to joining partnership capital inside the venture like this. So one of the primary rules is that profit can be negotiated. So before we start, we must agree on what is going to be the profit ratio. We have capital contribution, which is 20-80 in this case. However, different partners might choose to participate more or less in a business. We are permitted to change the profit ratio. So if one partner, for example, chooses to be more involved in the business, comes with different experience and things that really will add additional value to this partnership, that partner, due to this increased involvement in the business, might get higher share of the profit. And this is to give incentives for the partners to work harder. If party A is, let's say, sleeping partner, then they cannot get more than 20% of their profit from the actual economic activity. However, if the party A is working harder or more, or we want to give certain incentives, we could give them, let's say, 25, 30, 40. We could give a 50-50, for example, profit share. That is something that must be agreed before we start the business, this profit ratio. When it comes to the loss ratio, this by consensus is fixed. We cannot negotiate, and it is fixed according to the capital contribution. The reason why this is fixed is because it is fair. It is fair that parties share pain equally. It is fair because if you could negotiate, usually the stronger party would negotiate in such a way with the upper hand to push more loss onto the weaker parties. While at the profit side, reason why we can negotiate is because now these are incentives. So for example, if we increase performance of the business or a profit, in that case everyone gains more. So it is better to have 50% of a business that makes, let's say, $5 million in profit than 90% of business that makes just $1 million. So this is just something that is used to encourage innovation, competitiveness, entrepreneurial spirit in the society and the business. If we look at one particular case, we have example, investor A, investor B. In this case, their contribution is 40 and 60. So investor A is putting $40,000 into some sort of a business, and other party is putting 60. And let's look at the two outcomes. In first outcome, we have $10,000 profit, and in the second outcome we have $10,000 loss. So what would happen here? First of all, we need to ask ourselves, what is our pre-agreed ratio in terms of the profit? So in this case we have put 50-50. So 50-50, obviously that means that party A might work more in this business, and therefore there is incentive that while we could have done 40-60, we could do 50-50, 60-40, or whatever is the ratio that makes sense. Now in this case, when there is a profit, if it is 50-50, we said profit ratio, then both parties would split that in half. In a situation where we have a loss, we cannot go by the pre-agreed profit ratio, but we have to go according to the capital contribution, which in this case is 40-60, and therefore the first party would lose 4,000 and the second party would lose $6,000. So this is very, very simple idea. Based on this, we could look at any other arrangement which requires joint venture where two partners are putting some money into the business and so on. Now when it comes to making the Musharaka as a mode of financing, we understand that we can modify this Musharaka to suit different number of our needs. So we have a diminishing Musharaka, which is a form of partnership as defined by OFI, in which one of the partners promises to buy the equity share of the other partner gradually until the title to the equity is completely transferred to him. So for example, let's say most common question today is, how do I own home Islamically? We know with the banks, you would go to the bank, they would simply give you money and you are repaying the money. So by now we have understood that making money from money is something that is not permissible Islamically, so we cannot give loans and expect return. So for money to be useful, we said that money must be converted into something that is useful in itself. So if we are talking about Musharaka, that means parties, they must buy a property. This way, money becomes property. Now, when I have a property in my possession, I can then sell or lease this property. And this is what is happening in Musharaka. We sell that equity and we lease the part that we have. So in this case, if we look here, the way the financing would work in Islamic bank, and this could be for the property or the machine or anything really that you want to finance, you would start by bank and customer putting, just like we said before, jointly owning this asset. So bank would bring, let's say, 80% and customer would own 20%. So now in this case, if they were in a business of leasing the property, and let's say they lease this to another party, third party, and the rent was, for instance, $1,000 a month, they would get $200 for one party and $800 from the rent for the other party. But in this case, to make it as a mode of financing, we are assuming that the customer is using the home. So the customer is paying the rent for the remaining 80% of the property that does not belong to them, but they are using. So now they are using what we call usufruct, or the benefit, or we are using the property to live inside this house, and we are paying 80% proportionally for the part of the house that we do not own. Over the time, idea of course is that we want to add some extra money on top of the rent, by which we're going to start buying the equity from the bank or financial institution. So what starts happening is that customer would have a set of arrangement by which bank starts with owning 80% of the home, with the customer owning 20%, and then over the, let's say, 20 years or so, customer would be paying rent on the portion of the house that they don't own, and they would slowly acquire ownership stake, equity from the home. So that payment would be consisting from the rent and payment to acquire the equity. So over the time, for example, as the customer buys more equity, the stake of ownership in the bank would start reducing. So over, let's say, in a couple of years, bank would sell equity, and from 80% of ownership, the ownership would drop to, let's say, 75, and the customer's ownership inside this property would increase to, let's say, 25. Now, what this means is that a rental component would now decrease. So now the customer is only paying rent for the 75% of the property they don't have in their ownership. And then they continue to buy the equity slowly over a period of time, and we see that bank's ownership and equity inside the home is slowly decreasing to 70, 60, and so on. Eventually, what is happening is, as customer equity increases and their portion of the rental payment decreases, we will find ourselves in a situation at the end that the customer will become 100% owner. So with the last payment, they will buy last piece of property or last percentage of the equity from that home, and they will pay the last rent to the bank. So with that last payment, the customer acquires 100% equity in the home, and we conclude this particular transaction. Now, the benefit of these sorts of financing are many, but number one, many people say, is this the same like conventional finance and so on? Obviously here the transaction is, or the subject matter in these contracts is equity. So the customer is engaging in permissible leasing. They are buying the shares or equity inside the home. They are partners where the bank is trying to help customer to become an owner in this home. Now all of this arrangement will have all of these rules, and of course all of these rules of sale and contractual obligations are beyond the scope of this particular course, but it is important to say that this must be a genuine relationship that satisfies all the rules of sale, lease, Sharia compliant contracts, and so on. So when we look at this and compare it to conventional finance, we understand that the bank is making money from engaging in a real transaction with a real asset through a sale or a lease, while at the bank we would have a sale of money and the house is only used as a collateral. This sort of idea of buying the home and having the share or equity is the similar idea when we talk about, for example, buying the shares in the company. Often this topic of whether it's permissible to buy shares in a company comes when we are talking. When you buy shares in a company, the shares in a company represent unit of ownership in particular company. And because we become a shareholders or a partner in that business, we are receiving proportionate profit from the economic activity of that company. Of course, we are assuming here that company did pass Sharia compliance test when it comes to investing and buying the shares in the company. So this is a way to show how really partnership can be used to finance everyday assets and business or anything else really in everyday life. When it comes to the issue of lease and sale that are component or found in these sorts of contracts, we will talk about this a little bit later.